personal trust, SMSF. I call them like different swim lanes for, your wealth creation journey, right? And so how do you manage to basically grow all of them at the same time? And I think the accountant plays a really, really important part in bringing all of this together, right? I almost see that, they are the catalyst between a mortgage broker and a property investment advisor, right? Without accountant, nothing works, right? You can't bring all of this together at all.
You're listening to Helpmebuy Property Podcast, powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs, from evidence-based, data-driven buyers agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy, where we are training and teaching buyers agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to student investors. Connect now to experience it yourself, or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing.
Today, we are going to talk about property investment and taxes. We're going to bust a lot of myths for property and taxes. And we're going to talk about why a property investment advisor is a yin to yang to an accountant. Now, in order for us to have that conversation today, drum rolls, we have Mr. Sohail Merchant. Sohail, how are you today?
Good, thank you. Glad to be here.
And it's been a long time, I think, since you've brought you back on the show. So
it's been a while, yes.
Yes, and I think it's a perfect opportunity and a perfect time, right? Tax season, tax times, everyone.
Financial year. Yes, happy new financial year.
And to you too, happy new financial year. Yes. It's a perfect opportunity to talk about property investments, because everyone would be thinking about, okay, I'm going to go see my accountant and talk about property and the acquisitions that I've made and the acquisitions I'm going to make in the future as well. And so we are going to, and this is a really fun conversation today, because you're going to have a lot of conversations around property investing and the myths and, what does a property investment advisor do? I'm going to start basically off here. A property investment advisor is typically a person who is helping you make informed decisions about, buying, managing, or selling a property. Okay, their job typically is to, analyze the market trends, evaluate property values, and provide strategic advice on building like profitable, scalable property portfolio. And so the main goal typically is to, maximize returns and minimize risks. And that's where, when you talk about normal accountants, right? A lot of normal accountants always think about minimizing tax strategies. That's how they basically go around doing this. So tell me, how does a normal accountant's role differ when it comes to property investing? A normal accountant, which, sits in the office, you see them once a year, purely from a tax perspective, to an accountant that basically works beside you along the way.
Yes, as you mentioned, that primary focus is financials and tax obligations. So a normal accountant, they look after the clients from tax minimization strategy point of view. They don't look at your financial situation holistically. They don't collaborate with other professionals here. For example, yourself, property investment advisor. So the property accountants, they make sure or ensure the compliance with Australian tax laws, which are aligned with your wealth creation strategies. Okay, not just tax minimization strategies. They help you to optimize tax and make sure you are compliant with tax laws. It is called efficient tax management. Right?
Yeah.
You're just not focusing on minimizing tax. You're focusing on your goals, which are to create wealth, and along the way, how you manage your tax with your strategy there.
Yeah.
So they talk to mortgage brokers, they talk to a property investment advisor, and they collaborate with each other because they understand the same language. And then it helps the client to grow their portfolios.
Yeah. And typically my experience has always been that, instead of seeing your accountant once a year, there should be much more better periodicity that sits behind this. You need to see your accountant as often as you see your doctor, right?
That's right. I usually tell my clients that, look, if you're making a life-changing decisions or taking life-changing decisions, you tell your accountant.
Yeah.
If you're having a child, tell your accountant. If you're marrying someone, tell your accountant.
Yeah.
There should be some financial guidelines along the way. So periodicity is very important. Meeting with your advisors, including accountants, is important, definitely.
Yes. And people tend to treat this in a very, reactive fashion, right? They would have gone the whole year, they would have done stupid, silly things, and then they would go out and go to their accountant to seek refuge, protect me from the tax office now. And the accountants are no magicians. Look, they do an amazing job in tax minimization at that given point in time, but there are so many things that could be done better if you are thinking about this in a lot more proactive sense, right?
Correct.
One key thing that I always say to people, and this is for the viewers and listeners, is that, and I follow this religiously as well, that, at the end of the year, but also at the start of the year, have a plan in place, sit with your accountant, especially from a business owner's perspective. How much do you need to disclose? How do you need to have your financials set up? What do you need to do what do you need to basically take to the broker? How do you need to prepare for next year's financials, right? And I think that's where the core gist of the conversation is. A lot of people don't know what they don't know. They don't know how many properties are they going to acquire next year. And when meeting an accountant, the accountant is going to ask these questions. The mortgage broker is going to ask these questions. And that's where the property investment advisor, the mortgage broker, and accountant plays a really important part in bringing all of this together for you. Let's jump into, some of the exciting stuff. And so one of the topics that I have in front of me is, what are the key things or what are the key reasons it's important for you to speak to your accountant, or speak to your property investment advisor before you are speaking to your accountant? Let's talk a bit about that.
So first of all, you speak to before you come to your accountant, you need to have a plan in place, and to have a plan, you need to discuss with property investment advisor what you want to achieve. You want to, is a property investment advisor help you to strategize the plan, what you want to achieve in next 10 years, 15 years, 20 years. And then you come to your accountant and discuss that strategy with them, and they can help you along the way how to achieve those strategies or those goals while making sure you're compliant with the tax obligations as well.
Yeah.
So meeting with your property investment advisor regular basis is very important before you talk to your accountant.
Yeah.
Yeah. So that's a couple of things there. Another thing is that the property investment advisor, they're going to let you know that if you want to buy in trust or SMSF, they're not going to advise you about how it's going to work in terms of SMSF or in a trust. You have to come to the accountant, and they will explain you. If your property investment advisor is telling you that you should buy property in a trust or business or different business structure, then accountant can help you, guide you what to do exactly when you are buying in a trust or SMSF. Okay, because property investment advisors are not tax consultants. They are not tax advisors. They don't understand certain other things, but they understand your goals. And your accountant would understand your goals by talking to the property investment advisor. They can talk to the mortgage broker as well if you have already, and they can work together and they can guide you how to plan accordingly in terms of taxes. If you are thinking in next 5 years you want to buy 2 investment properties, for example, how to structure them, what sort of cash flow you should be expecting from these investments. So that will help you for the borrowing capacity for the next purchase, things like that.
Definitely. And I see a lot of people who reach out to their accountants, as I said, they always think about the tax minimization side of things. The accountants do not know what your plan is of your property acquisition. And so typically going to them armed with some of this information is quite important so that they can provide you very direct and focused advice in a lot of these things. And I think you make a really important point as well. When it comes to trust and structures and SMSF, it's important to have your accountant on board along the way, right? How do you use SMSF to your own advantage? Do you need to move some money from your personal to SMSF? How do you leverage some of these things in order to, build a sustainable and a scalable property portfolio? How do you grow the wealth in all different tangents, in different directions, personal, trust, SMSF. I call them like different swim lanes for your wealth creation journey, right? And so how do you manage to basically grow all of them at the same time? And I think the accountant plays a really, really important part in bringing all of this together, right? I almost see that, they are the catalyst between a mortgage broker and a property investment advisor, right? Without accountant, nothing works, right? You can't bring all of this together at all. So yeah.
That's right. Yep.
How about how closely an accountant works with a mortgage broker? Let's explore that a bit. Where do you think the place or what your experience has been, when it comes to mortgage broker and accountants?
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book. It's easy to read. It has a lot of stories. It has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
Most of the time, when a client comes to us, they're asking if they want to, if they're just letting us know that mortgage brokers told us that they can't borrow for future investments, or they have difficulty in serviceability and things like that. But of course, mortgage brokers, they don't understand the tech side of things. So when you're speaking to your mortgage broker, what they think about, they just think about how to reduce your interest rate. They don't think about most of the time that how you're going to increase your borrowing capacity for future purchases. If you have a goal to purchase more than one investment property in next 5 years, its interest is not the only consideration in the factor.
Definitely.
You need to think about how you're going to keep getting the cash flow in, or keep make sure that you have enough borrowing capacity for future purchases as well. Because market changes every month, right? So you can miss out on opportunities if you don't have right plan in place. So mortgage brokers, what they think that just keeping the interest rate low will help you to grow your portfolio. It doesn't work like that. You have to make sure that you have enough serviceability for next time. So that's why we guide the mortgage brokers as well.
Yeah.
No interest. Don't think about the interest. It's a small thing. You need to think holistically. What else you can do? The business structure is one of the examples. Some mortgage brokers don't even go there and guide the clients that go buy properties in trust, for example, because it gives you more flexibility, not just tech side of things, from borrowing capacity perspective as well.
Yeah.
So it is very important that when you speak to a mortgage broker, you speak to the accountant as well, who knows about the property purchase, property investment, property development, and things like that.
Yeah. And paying tax is not a bad thing, right? There's a massive stereotype around this. Let's talk a bit about that. People think that, I need to squeeze all the money and pay zero tax.
Yeah, it doesn't. I mean, as you know, the taxes and death, they are certain. You cannot avoid them, right? So taxes are not bad things. You need to leverage it. If you are a high income earner, you're required to pay a certain amount of tax. That's fine. There's no harm in minimizing it, or make sure your tax is working for you. Optimize tax. That's okay. Keep paying the taxes. At the same time, leverage your income to increase the wealth, right? So if you're paying taxes, it's a good thing. Which means the bank would love you because you're paying taxes. You have high income and you can manage. If you're managing your taxes, earning capacity is good enough, then banks would love you and they can give you more money.
Definitely.
So you just need to manage efficiently the tax side of things. That's the only thing.
Yeah. And it's all about showing the profits, especially for the business owners, right? It's about showing the profits and holding it in retained earnings so that, you can tax plan it for the future as well, right? A lot of people don't think about it from that perspective. Yes, PAYG people are sort of stuck because, they get all the money, upfront deductions, etc., all of that. But again, that's where the trust plays a big part. And, we've been using trust for a very long time. But let's talk about some of the strategies that people can employ and use in order to, manage their tax better. The first thing that naturally a lot of accountants default to is negatively gearing. So they'd be like, buy a property in your personal property portfolio, make sure that it's costing you $50,000 a year to hold. You add depreciation on top and basically you can claim it against your own personal taxes.
Yeah, depreciation, it's a good tool. It's not bad. As you mentioned, negative gearing strategy. Lots of accountants out there, they want, when they employ the minimizing the tax strategy, they always suggest go with negatively geared properties. When you ask them what sort of investment should I get into, then the first thing they said, buy a investment property which are negative geared. And when you want to buy a negative geared property, usually you buy newish kind of property, newish estate, so you can maximize the depreciation there as well. So when you have rental losses, you can claim against your personal taxable income, which reduces your tax liability. And then you love that accountant because you're getting the highest possible refund because of that. But are you creating wealth for yourself? It is a short-term goal to get some cash back. That's fine. It's a cash flow incentive. There's nothing wrong with it. For some people, it can work. But if your goal is to increase wealth in future by property investment, then negative gearing is you don't need to worry about the negative gearing itself or cash flow benefit. You then buy a property which is not, you still negatively gear, some benefits and grow your wealth at the same time. Okay, when people get stuck when they buy house and land kind of properties where they can claim maximum depreciation, and then they're stuck there because the property is not going to grow too much because they're already paying premium for that property. Okay, they're claiming depreciation. If they're selling the property within 5, the depreciation will be added back for capital gains purposes anyway. So you basically deferring your tax for future.
Yeah.
So depreciation
is a very important point that you make. That depreciation typically is not a permanent benefit. It's just a temporary cash flow benefit. It's not a real wealth creation tool, right? A lot of people don't understand this. And for the sake of viewers and listeners, let's understand this with an example, right? So if you buy a property for say $500,000 and you're claiming say $10,000 depreciation over 5 years, and let's say it's $50,000 depreciation. Technically, from tax office perspective, that property is now worth $450 because the book value is 500 minus 50 is 450. And so if you sell it for say 500 still, typically that 50,000, the tax office is going to add it back.
Correct.
And basically go back and calculate this again, right? So, or if you and so it's not a real benefit where this benefit stays with you till you die or till you're selling the property. It's typically a cash flow benefit that you're getting the refunds in any possible given year. There is nuances around this. People would argue that you get 50% discount rule applied to depreciation benefits, etc. All of those things, and we're not going to get into that sort of detail. But for people understand that tax depreciation is you just deferring the taxes into the future. That's all you're doing, technically. Amazing. There is another thing, and there is a lot of news around this. And when we first talked about this, we are going to unpack this a bit. And this is the 6-year rule about the principal place of residence and rent vesting. Let's talk a bit about that.
Yes. So as you know, when you have a principal place of residence or any properties which you rent it out and you're renting at the same time, you're not living in that property, that's called rent vesting. And that principal place of residence which you're renting it out, if you sell that property within 6 years of renting it out, you still can claim or classify that property as a principal place, and you can claim a CGT exemption, capital gains tax exemption for that property. So that's a very famous or popular strategy. Lots of people, it's not a strategy. It's a convenience. People move around different places. and rent different places, and they still have a principal place of residence. They don't want to sell, they rent it out, so they can sell that property later on and claim the CGT exemption on that. So that's 6-year rule. So 6 years is basically you have 6 years to keep renting it out, earn money from there, and move that in that property later on.
Yeah,
that's the idea. Yeah.
Typically, when if you move back into the property in those 6 years term, basically, then the 6-year rule basically kicks in again.
Correct.
So
that's
from that
right.
point onwards, you get another 6 years, and so I've seen a lot of people doing that where they hold a quality asset and they'll move back in for 3 months, to kick that 6-year rule again, and then go back and reinvest in again. We're talking about astute investors, but there is one more thing that a lot of people don't talk about, and we were talking about this the other day in relation to the 6-year rule, which basically states something along the lines, and you can explain this a bit better because for no voice like me, I might not be able to explain this to nth level. When the 6-year rule typically expires and your property is now exposed to capital gains tax, there is a valuation that basically gets kicked on where you are basically saying, okay, if you for example, let's understand this from an example's perspective. You bought a property for 500,000. You lived in it for 6 months. Now you're renting out, and this principal place of residence is being rented as well. Okay, and so the 6-year rule kicks in. That property from 500,000 goes to say, almost $1 million. Okay,
mm-hmm.
And now typically that $500,000 is tax free, and you are still within that 6-year period. Now, once the 6-year period has lapsed and you haven't moved into the property, and now you are in year 7, and this property goes from $1 million to say $1,050,000. You are not exposing yourself to the whole from 500 to $1,050,000. You're only exposing yourself to $50,000 because that line in the sand has been drawn. Is that right?
That's right. So that's called substitution rule. So you can use instead of using original cost base to calculate your capital gains, you can use the substitution. And when at the time of the 6-year rule expiring or tenants moving out of the property, or you want to move in or you want to rent it out again or whatever, so you get a valuation done on the property, use that valuation as a cost base to calculate your capital gains tax. So you're not paying capital gains, first of all, when you were living in that property for a while, and then 6-year rule. And after that, you're locking in the cost base for that property by making sure that you have valuation done after 6 years expire. So you can use that valuation to calculate capital gains for whenever you decide to sell the property.
Yeah. And a lot of people make that mistake. They don't remember doing the regular valuations, right? So it's important for people to understand that, whenever you are using some of these, what I call it is conveniences for your own sake, make sure that you know when to do the valuations. There is an exit valuation, there is an incoming valuation on a lot of these things. And if you're not sure, speak to your accountant.
That's right. Exactly. Yeah, reach out. So whenever you're making a decisions, life-changing decisions, moving in, moving out, talk to your accountant.
Yeah, perfect. I'm going to, keeping the golden nuggets at the very end, you're going to talk about something that has been on my mind to talk about for a really long time. And I know I've spoken to a lot of clients about this. And this is about how do you lock your property portfolio for 5 years by doing something that typically not only locks your property portfolio, or your property portfolio might be going negative, but you are still exposing yourself to the tax office. Let's talk a bit about that. I know you've been talking about this before the podcast, but it's an interesting thing where, your property prices may have gone from 500 to say 450. And so you're actually making a loss on that property, but you still owe money to the tax office. The tax office might still be up for an extra $50,000. And so you might be actually up for a bill of almost like, $70,000 or $100,000 in this particular instance. And so let's unpack that as to, and I see 95% of the investors, making that mistake, because anyone who basically goes out and buys a house and land package or off the plan property, or buys a land and builds a house on it, basically they are exposing themselves to something, this example is basically applicable to them. So let's talk a bit about that, Sohail.
Sure. Yeah. So as you mentioned, lots of investors, when they are chasing negative gearing and chasing depreciation expense for taxable income, they buy a land, they want to build property on that so they can maximize the depreciation. And sometimes most of the time, as you mentioned, 95% of the time, they don't know they're exposing themselves with huge tax bill, which is a GST. When you're buying a land and you develop that property, you want to sell that property, you have to pay GST because it's a new dwelling. That's a requirement. Lots of investors out there, they don't know. They're buying property. If they sell within 5 years, they have to pay GST, even though they are not making too much money out of it. If it is land there, for holding cost is there, while construction is going, they have to pay the interest on the loans. Maybe they have fixed interest period there, for example, for 5 years, interest only payments. Keep paying the interest there. If you are building that house for selling, to rent it out, you keep it for 5 years. Then during that 5 years period, you won't be able to borrow more, or you can't do anything else. You are locked out because you're making sure that you want to build that house and then you want to rent it out. But if for some reason you're not able to, when you are building the house, okay, and you don't want to sell that house, but you want to rent it out. For some reason, you have to sell that house, that you are exposing yourself a GST bill from tax office, because that new dwelling, you have to pay GST on it. Depreciation, as we mentioned, as we discussed before, it is just a temporary benefit, and it is not helping you while you're constructing anyway. So,
And typically what tends to happen with a lot of these new builds is because you're buying a small piece of land.
That's right.
And you're building a house on it. Typically the values might not go up as you would expect, right? A lot of
performance is not going to be there.
Yeah, because of these house and land packages and the way they're designed, there is massive comms that goes out to the land person. And if it's a house and land package, then the builder takes and passes on the comms to, someone who is basically help you sell these house and land packages. Majority of these house and land packages either sit neutral or sometimes go negative because there is a higher supply and lower demand in majority of these areas. What tends to happen and you make a really important point, if these don't go up in value and, they're sitting up neutrally geared or not neutrally geared, but they're sitting up at their fair value, which is the acquisition price, and it's sitting in your own personal name. Now what you've done is you've locked in your servicing. You can't sell them because if you sell them, you're exposing yourself to capital gains tax. And these are not growing in the value. And so there is an opportunity cost in there as well. And so what a lot of people end up doing is, they buy one or two of these and you have basically locked in your property portfolio for 5 years, sometimes even 10 years, because each property would have a 5-year rule attached to it individually. So if you buy one and then 3 years later you buy another one, you've basically locked in your property portfolio for, subsequently 8 years or 10 years. And so a lot of people don't think about this. They only find out about some of these things in retrospective. They go and speak out to their accountant or they end up selling something and they get a massive GST bill and they'll be like, oh shit, I didn't know that, I had to pay GST on these things. Even if unless you are buying and building it for your own personal reason to live in, that GST bill is definitely there for you to take.
Correct.
And so that 5-year rule, no one talks about where, the ATO is behind your back, even if your property value goes back, because, GST is something that they would never let you get out, right? Or they would never let you, get away with.
Yeah, that's right.
Any final advice, Suhail, for our listeners and viewers?
Yeah, final advice, look at your financial goal holistically. You need to collaborate with professionals. Make sure you collaborate with your property investment advisor, your mortgage broker, your accountant, and make informed decisions. You need to make informed decisions to make sure you efficiently manage your taxes and grow your portfolio at the same time. So talk to your professionals and then seek advice.
Golden words. Thank you very much for sharing this. I think the important thing or takeaway from my perspective is, review your strategy regularly and make sure that, you see your accountant as often as you go out and see your doctor or other financial advisors. They provide a lot of value, and especially since this is the end of the year and you're starting off the new year, make sure that you go out and speak to your accountant, make sure that you go out and speak to your property investment advisor, make sure that you understand, what your acquisition strategy looks like over the next 1 to 2 to 5 years, and speak to your accountant, speak to your mortgage broker so that they can show the right accounts, they can divvy up the right information and present a better portfolio and profile to the bank so that, you can get the leverage that you really want. Okay. If you're looking for a property portfolio fixer, please do reach out to info@helpmebuy.com.au or jump on our website, investorpartner.com.au. Thank you for listening to us today. Stay safe, take care, keep smiling, be kind. This is Moxin. So I'll check.
Thanks.
Adios.
Bye.